Right then, no fluff, no long intro. Let's get straight to it. Everyone's looking for that one trade that goes absolutely parabolic.
Right.
That 10x monster. And 9 times out of 10, it all starts with one thing, a breakout. But most of you are getting rinsed trading them.
A breakout, for those who prefer English to crypto Twitter, is when an asset's price moves decisively past a previously established ceiling, a resistance level, or floor, which we call a support level. It's a foundational concept in the CMT Level 1 syllabus, for a reason.
See, decisively, that's the word. This ain't a gentle knock on the door, mate.
No.
This is a SWAT team blowing the door off its hinges. Think of a price chart. The price goes up to, say, £50. It gets rejected, bunk. Tries again a week later, bunk. That £50 level is a ceiling.
Right.
A breakout is when the buyers come in with overwhelming force and smash right through it.
And that overwhelming force has to be visible through a massive spike in trading volume.
Yes.
It's the one thing we both agree on. A price moving past a level on low volume isn't a breakout.
No way.
It's a tourist wandering into the wrong neighborhood who's about to get sent straight back.
Exactly. Volume is the proof. It shows conviction. It shows the big money is making a move. Without that volume, you're just watching noise. It's a trap, and it's set for you.
Which brings us to the core problem. Is it a real breakout or is it a fake out? The statistics on this are, well, quite brutal, actually.
Oh, here we go.
Thomas Bolkowski, who's done extensive research, found that even on clear chart patterns, breakouts can fail about a third of the time. For intraday traders, some data suggests the success rate is even lower.
The spreadsheet warrior is here to scare everyone off. Mate, if you trade based on historical stats, you'll never place a trade.
Well,
It's not about the raw percentage. It's about learning to tell the difference between a pro move and an amateur one. You can't be scared of the fake out. You just have to know how to spot it.
and how do you propose to do that, Professor Chris? By interpreting the mood of the candlesticks?
Oh, you cheek. You laugh. But yeah, kind of. A real breakout has big, thick, confident candles closing way above the level.
Right.
It screams power. A fake out is pathetic. It's a long, spindly wick that pokes its head up for a second before the price gets slapped back down. It's all hesitation, and the volume is dead.
What you're describing is institutional liquidity hunting.
Exactly.
Large players know that retail traders will have buy-stop orders just above a key resistance. They engineer a small move to trigger those orders, absorb all that liquidity, and then reverse the price, catching everyone offside. It's a classic and wryly painful maneuver.
And that's why you don't just ape in like a degenerate the second the price crosses the line. This is the alpha right here. Listen up. You wait for confirmation. My favorite way? The retest. Let the price break the ceiling, let it run a bit, then you watch for it to dip back down and touch that old ceiling.
Okay.
If that level, which was resistance, now acts as a new floor, new support, that's your 5-star entry signal.
I must admit, for all your bravado, that's a surprisingly prudent strategy.
Ha!
Their retest confirmation. You're essentially letting the market prove to you that the dynamic has genuinely shifted.
Yep.
You're sacrificing the first, say, 5% of the move to increase your probability of catching the next 50%.
See? There's a brain in there somewhere, Morgan. Teasing. It's not about being first, it's about being right. Let's look at Bitcoin. Think back to the break of $20,000 in late 2020. It tapped that level and failed for weeks. The tension was building. When it finally broke, it wasn't a little pop. It was an explosion on biblical volume. It retested the level briefly and then just left. That was the signal.
A perfect example, but let's provide some balance for the listeners. What about the people who bought the Ethereum breakout above $4,800 in late 2021?
Oh, good one.
That looked like a classic breakout to a new all-time high, right before it fell off a cliff into a year-long bear market.
That's the perfect counterpoint, and it brings in the most important thing, context. Context is king. That ETH move was a tired end-of-cycle move.
Right.
Asset was already up a ridiculous amount. The best breakouts, the ones that really run for miles, come from a long period of consolidation.
Okay.
Think of it like a pressure cooker.
Okay.
The longer the price grinds sideways, building energy, the more explosive the release when it finally goes.
So you're introducing another variable, the pre-breakout price action.
Exactly.
A long, tight consolidation range is a better sign. That makes sense from a market mechanics perspective.
Yeah.
It shows a genuine battle has been fought between buyers and sellers, and one side has finally, exhaustively won. It's not just a random speculative spike.
Exactly. Look for the coil, the price getting squeezed into a tighter and tighter range, like in a symmetrical triangle pattern. Volatility dries up, the chart gets boring.
Right.
That's precisely when you should be paying attention. When everyone else is asleep, the big move is being planned. The breakout of that boredom is what pays the bills.
Okay, let's make this super practical for everyone. A listener sees an asset, say a random crypto altcoin, approaching its all-time high. What is the step-by-step process to not get liquidated?
All right, solid question. Step 1, don't get emotionally attached. Zoom out, look at the context. Step 2, watch the volume like a hawk. Is it increasing as the price nears the level? That's a good sign of genuine interest. Step 3, the break itself.
Okay.
And we want to see a big, fat, green candle close decisively above the level on the daily chart, not a silly little wick on a 15-minute chart.
And your stop loss, you have to have one. Where does that go?
Crucial, non-negotiable. If you're an aggressive trader and you buy the initial break, your stop loss goes right back inside the previous range.
Right back in.
If the SWAT team kicks the door open and then immediately retreats, the mission's a failure. Cut the trade loose. No questions asked.
And for the more, let's say, sensible traders who wait for your golden retest?
For the sensible spreadsheet club, you have more patience. You wait for the price to come back down and touch that old resistance. When it bounces off that level, proving it's now a floor, you enter. Your stop loss then goes just below that new support level.
Okay.
It's a much tighter risk. You're risking less capital for what is now a higher probability setup.
Which brings up the fundamental debate for any trader. Is it better to be aggressive or prudent? The aggressive trader who buys the break catches the whole move if it works.
Right?
But the prudent trader who waits for the retest might miss the trade entirely if the rocket ship just leaves without looking back.
And that's the art of it, isn't it? There is no single right answer. It depends on your personality and risk tolerance.
I didn't know this was a section called Intelligent Points.
For me, sometimes I'll put on a small feeler position on the break and then add my full size on the retest. Best of both worlds.
A hybrid approach, very diplomatic of you. But let's not forget the other side of the trade, setting profit targets. It's one thing to get into a trade, it's another to know when to get out.
Yeah.
A breakout can reverse just as quickly.
Another great point from the CFA Konya. You can't just ride it forever with diamond hands until it goes back to zero. A simple method is using measured moves. If a trading range was, say, $20 from top to bottom, you can project a $20 target from the breakout point. Or you can use Fibonacci extensions. But the simplest way is just look left on the chart.
Okay.
Is there a major historical resistance level way above? That's a logical place for the price to run into trouble.
Or even more simply, take at least partial profit when the momentum starts to wane.
Yep.
You know when you see a series of strong, powerful candles, and then they start getting smaller with longer wicks at the top. That's a sign of exhaustion. The buying pressure is drying up.
Exactly. You can't be greedy. The market gives, and the market can take it all back, plus some. A good breakout trader knows when to take the money off the table and start looking for the next setup. It's a rinse and repeat process, not a one-time lottery ticket.
So to summarize our little masterclass, a breakout is a high momentum move past a key chart level.
Yes.
Its reliability is questionable and highly dependent on context and, most importantly, confirmation.
And the holy trinity of confirmations are a long consolidation period beforehand, a massive volume spike on the break, and a strong candle close above the level.
Right.
And for the pros in the club, you wait for the retest to confirm the level has flipped from a ceiling to a new floor.
And above all else, you must have a predefined stop loss because fakeouts are real, they are frequent, and they are designed to separate you from your capital.
Couldn't have said it better myself. You're learning, Morgan. Maybe there's hope for you in your spreadsheets yet.
Don't push it, mate.
Right, that's enough alpha for one day. If you want to chop these ideas up with us and the rest of the crew, the link to the private chat group is down below. Get in there.
Now, here's a question we'd like you to think about. Are you more of a buy the rip aggressive trader or a wait for the retest prudent trader?